Welcome to How to Make Money in Stocks with Investors Business Daily, featuring market commentator and host of the IBD Market Wrap, Amy Smith, and Matthew Galgani, host of the IBD Stock Analysis and editor of the IBD Extra newsletter. Tune in each week as we use history, not hunches, to help you stay safe in today's market and get in early on tomorrow's winning stocks. Now, here's Matthew Galgani.
Welcome, everyone, to another episode of How to Make Money in Stocks with Investors Business Daily. Because of some scheduling issues, we ended up recording on Thursday this week, but we hope you're going to enjoy the show.
And today we're going to talk about average daily dollar volume and why this is so critical to pay attention to in picking great stocks.
If you've been listening to the show for a while, and if you've been with IBD for a while, or just investing in general, you hear us always talking about watching what the big fund managers are buying and selling and paying attention to the volume, the amount of shares that are traded on any given day or week in a particular stock, how that matches up to the average for that particular stock. So today we want to step back a little bit and get into that idea in a little bit more detail so that you really get a sense of the scale of what these fund managers are buying and selling and how that absolutely does affect what kind of stocks you should be buying. And one of the keys to this is not just looking at the average shares that are traded each day, but to look at the average daily dollar volume that is traded every day.
All right, so let's talk about what is average daily dollar volume and how do we determine this? So this is the number of shares that a stock trades per day on average times the stock's price. Let me give you an example of that. We have GoPro, all right, it trades on average daily 5.8 million shares. If we multiply that times 60, which is just about the current price, that will give you the average daily dollar volume. Now, why is this important? Well, first of all, dollar volume liquidity is very important to institutional investors because they make such large trades. When a stock is highly liquid, it's easier to enter and exit positions, and it's easier to buy and sell without influencing the stock's price. And there's another key element here. There will also be a very small bid-ask spread. In other words, if they want to buy it at a certain price with a more liquid stock, they're more likely to have their fill. They can get filled. The order will be filled.
Right. And it can take quite a long time for one fund to establish its own position, especially when you're talking about these really large funds like a Fidelity Contra Fund or something like that. If they want to take a meaningful position in a stock, it can take literally hundreds of thousands or millions of shares. And if that stock is trading at $50, $100 or so, you can see how the numbers add up very quickly. So that liquidity, that ability to get into a stock without hurting yourself by buying enough shares to push up the price is very critical for large fund managers. And one point to stress here is that's just one fund. Now, if you times that by dozens of funds getting in or hundreds of funds getting in, you start to get a sense of how much volume and how much dollar volume is kicking into a stock. And that's what a stock needs to make a large, sustained upward move. Not just a flash in the pan move on a very thin stock that may go up for a couple of weeks or a couple of months, but for something like an Apple or a Netflix or a Facebook, that type of stock to go up over a long period of time, you have to have the fuel that's provided by these large investors.
Now let's back up here a second. Bill and Scott both have said in the workshops the average daily volume that they're looking for. This is how many shares are traded per day. They look for 1 million or higher. Now, Bill and Scott also do not buy cheap penny stocks. So let's just take a little ballpark here. Let's say that a stock is traded at $20. You multiply that times 1 million, your average daily dollar volume then becomes 20 million. Now, a lot of times higher priced stocks are the ones that move higher. Mm-hmm. It's in Bill's book, it's in everything that we teach, it's in the workshops, it's in the model stock books. Usually these are not the penny stocks that are making the great big moves. They are higher priced stocks. If you look at how expensive Netflix is right now, or how priced Priceline got, when at the peak when it was really trading super high, these are not cheap stocks. But remember that Bill says stocks are cheap for a reason.
That's right. And also, these thinly traded, cheaper stocks, generally speaking, tend to be more volatile than the larger cap stocks that do have a large dollar trading volume. Now, if you're looking at Investors Business Daily, looking at articles, you'll see sometimes a reference to a stock that is thinly traded. And as a general rule, kind of a minimum that we look for is typically around 400,000 shares or more, again, as a minimum. And there are exceptions to this one way or the other, plus a daily average dollar volume of at least $20 million or more. So if you have a stock that's only trading at $5, but it's trading 400,000 shares a day, that's still only $2 million a day. So it's well short of the $20 million in liquidity that we're typically looking for.
And let's take a look at two fund managers that I interviewed for my book, and let's see what they're looking for in average daily dollar volume. Okay, we have Keir McDonough from Boston, and he looks for an average daily volume of at least 700,000. Okay, that's how many shares are traded per day. He's looking for a dollar volume of 70 million, and he tends to drift towards consumer stocks that he really understands. Now let's compare that with Jim Ropel. Now Jim has parameters that are even higher. Okay, he's looking for stocks that are going to make enormous moves. When he's establishing a position, he could be investing $15 million or more with each purchase, by the way. So he's looking for extreme liquidity. He's looking for an average daily dollar volume of 200 million or higher. Again, we calculate this by multiplying the number of shares that a stock trades by what is the price per share. And these are the stocks that are more likely to get that institutional support from the mutual funds, the banks, the pension funds. And Jim says part of the magic secret sauce for finding the market's biggest winners is high liquidity combined with soaring earnings growth.
Now, we should emphasize that just because a stock does trade a lot of shares every day and has a high average daily dollar volume, that does not mean that it'll just continually go up and that it won't form bases or have pullbacks like every other stock, or that it's not volatile. Every stock has the potential to be volatile. There's no getting around that. But when you are going through what stocks you want to buy, do keep that in mind. Don't look at just the volume in terms of the average daily shares that are traded, but do look at the dollar amount, because it does separate the truly liquid institutional quality stocks from the lesser, thinner traded stocks. And again, keep in mind that when a stock is making a big move that may take months or years, you have multiple funds, again, dozens, could even be hundreds of funds getting into it. And they're only going to get into stocks, generally speaking, if it has the liquidity that helps them get in within the price range that they want, and also to get out when they want to get out without seriously dropping the price by their own selling.
Now think of it this way: when there's a high level of investor interest in a stock or in an ETF on a major exchange, it will tend to be highly liquid. All right? And that is because the higher the interest in the stock, the more people want to climb on board.
Sure.
And of course, these are the big professional investors, and they've got to put their money somewhere. So they're looking for, where is their big interest? And again, we get back to the same principles of CanSlim. We're looking for stocks that are producing huge earnings. Why are they producing huge earnings? Because it's in big demand by the public. Why is it in big demand by the public? Because there's a new product or service that's really cool.
And it has big mass market appeal. That doesn't necessarily mean it's consumer driven, but it's doing something in an industry that is large and has potential to grow down the road.
Yeah, if you're buying a lug nut for your car and only you and your next door neighbor are interested in it, that's not mass appeal. But we had some liquid winners from the past that I want to mention. These have big daily dollar volume. They had huge earnings numbers, and of course they made massive moves. We had Baidu, Priceline, Green Mountain Coffee Roasters, Apple, Lululemon, and Chipotle. Now, we're not saying that you can't possibly play some of the thinner names. You just have to know that the big institutions can't get in some of those names and get out of it. They might cause the whole stock to go way up on a day or way down if they go in and out of these thinner names. That's why they look for the bigger stocks.
And the thinner stocks may move quicker than some of these larger cap stocks. So if you're trying to get a quick little gain in a stock, that may deliver it for you. But the reverse is also true. on a bad earnings report or some news. Maybe it's a biotech stock that doesn't have a good report for its latest trials. That can get whacked instantly. And of course, again, it can happen to larger cap stocks as well. But if you look at some of the names that Amy just mentioned, like Netflix and Chipotle Mexican Grill and others, that made these huge runs over multiple years, they tend to be the ones that are getting this institutional support, this institutional sponsorship in the form of a lot of shares being traded and a lot of dollars going into it every day.
And they're continuing to do, if they're going to continue to go up, they have to be doing something new. How many different products has Apple come out with? And is there big demand for those products? Netflix is another one.
Sure.
You know, it went through a correction, but of course, recently they've turned around again. They are doing something, and what do we see? Consumer demand. Now we're seeing consumer demand for that overseas.
Sure. So let's take a quick break, and then we'll come back and talk about some of the newer IPO stocks that do have this institutional quality liquidity. And we'll talk about some of the numbers in terms of how many shares are these funds buying in these stocks and how much dollar volume is involved.
When you start investing, it's critical to have a game plan for success and a simple routine that fits your schedule. With Investors Business Daily, you get both. The Market Pulse shows you the right time to buy or move to the sidelines. Unique lists like the IBD 50 highlight stocks that could be on the verge of a big move. And IBD Stock Checkup gives you pass or fail ratings for any stock before you buy. Get a free trial at investors.com/radio show. That's investors.com/radio show. Welcome back to How to Make Money in Stocks with Investors Business Daily, featuring market commentator and host of the IBD Market Wrap, Amy Smith, and Matthew Galgani, host of the Daily Stock Analysis and editor of the IBD Extra newsletter.
So now let's take a look at some more recent IPO stocks that have gone public in the last couple of years or so, and see which ones really do have that liquidity that we look for in a stock. And one example is GoPro.
Yeah, and we're not saying this is go out and buy GoPro right now, although it certainly has turned around from the bottom, and it certainly has made a little bit of a comeback. We're just using this as an example, all right? GoPro trades an average daily volume 5.8 million shares. That's how many are traded generally every day. The current price is about $60, all right? So if you multiply 5.8 million in average daily volume times $60, you will get 98 million. That's the average daily dollar volume. All right, so you're multiplying 5.8 million, the average daily volume, times $60, which is about the current price. You're going to get 340 million. Okay, that's the average daily dollar volume. Remember that Jim Ropel sets that bar high. He's looking for 200 million. Keir said he's looking for at least 70 million. Now, what we're going over here doesn't mean that you have to look for 200 million in average daily volume. Remember, he's a fund. He's putting in $15 million with each buy. Okay, we don't necessarily trade that much money. You don't have to trade stocks that have quite this high in the daily dollar volume. We're just giving you some examples of stocks that are very, very liquid.
And it's one more thing to check as you're going through your checklist of what stocks you want to buy. Now, maybe you're going to have a mix of thinner stocks as well as some of these larger cap, more liquid stocks, just to have a bit of a balance within your portfolio. But another example is Mobileye, which we covered in the IBD stock analysis last week, and it actually broke out and started to make some good gains recently. That is a very liquid stock. It trades around 3.2 million shares a day, and it's trading in the neighborhood of $54 or so. That comes out to $172 million traded every day in that one stock. And to give you a sense of what's going on with the funds, Fidelity Contrafund is something we all know. It's been around for a long time. It's a very large fund. It owns 3.74% of the float of Mobileye. That's the available shares on the market. So it has 3.74% about. Again, these numbers may change as funds report, but that gives you a ballpark idea of how much Fidelity Contrafund owns of Mobileye. But that only represents 0.98% of the Contrafund assets. So it's a little bit less than 1%.
But it's a lot of money, Matt.
It's a huge amount of money. But again, the reason a fund like Contrafund would get into something like Mobileye aside from, of course, the fundamentals and the story and all of that. But just in terms of the trading, it's only going to get into a stock that offers it the chance to establish a relatively significant position without hurting itself by its own buying. And it may take weeks, it may take several months for Fidelity to establish that kind of position in the stock, but it can do it because of that huge dollar volume and the fact that Mobileye is trading in the neighborhood of 3.2 million shares every day.
And remember that these guys have done their due diligence. They usually have, and Fidelity Contra Fund might be a little bit different, but there's usually a team of analysts, whether it's a mutual fund or a bank or a hedge fund, right?
Sure.
And the reason there are so many analysts is to dig through all these numbers to find the companies that have this great potential. Now, in the case of Mobileye, as you're talking about, it does not mean that this stock will go to the sky, but it has the safety software technology that are going to be installed in a lot of cars. And of course, the insurance companies like this, because if you have a modern car, Matt, and it's got all the safety features, it's likely to protect you from getting into an accident. I want to mention a newer IPO. We cannot measure it by one day, okay? That's why we wait for stocks to form a base. And usually the very first day that a stock trades a newer IPO, you see this massive volume. But there was one this particular week, Matt, that really, it meant there was huge institutional interest. Fitbit came out, the ticker symbol's FIT. On that first day, more than 45 million shares were traded at a price approximately around $30. So that just tells you the huge potential. Now, why would that have attracted the interest of the institutional investor? It has had several quarters of triple-digit earnings, coming in the most recent quarter of 475%, and their sales were up 209%. And again, this is not a stock recommendation. I just want to use as an example, where does huge money go, and why does huge money go somewhere?
Sure. And again, like we've said many times on this show, you never want to buy a stock on the first day that it goes public. Wait for it to form a base, prove that it has sustained interest among the institutional investors, and then breaks out on good volume. Now let's talk about a couple of other relatively recent IPOs. Two are CyberArk and Tableau Software. The ticker for Tableau is DATA, data. And the reason for that? It's part of this whole big data trend, which is, of course, tied to the cloud and the Internet of Things, where everything is tied together. That obviously is generating massive amounts of information on everybody's networks. Somebody has to track that, analyze it, and make use of it. And that's where Tableau Software comes in. And also CyberArk, on the security side, helps organizations protect their most sensitive information. And if you look at these stocks, both of them do have institutional quality liquidity. For example, with CyberArk, and the ticker there is CYBR, it trades around 2.3 million shares a day, and it trades around $73 a share. That gives you a daily dollar volume of $168 million. And for Tableau Software, it trades around 1 million shares at $122 a share for $122 million, give or take, every day in dollar volume.
All right, now let's talk about Netflix. You've listed some great examples there, Matt. Netflix has 6 top funds that have a stake in it. And when we say the top funds, these are the funds that Bill has recognized that are funds that typically perform very well. We have a list of those in the paper every day. This list includes, interestingly, small cap growth funds, mid cap, and large cap funds. So all across the board, you have different types of funds that are in Netflix. In addition to that, Matt was talking about their position size. Each of these funds, each of these top 6 funds that have a stake in Netflix, and of course there are many other funds that have a stake in it, but these top ones have 1 to 2% of their fund in Netflix, which is pretty significant when you take a look at what they're doing. Now let's take a look at average dollar volume. Netflix trades 2.7 million shares per day on average, okay? The price is about $665. You multiply that out, the shares traded per day times the price of the stock, and you get about 1.8 billion. That is a huge daily dollar volume. All right, that's institutional in quality. That's exactly what we're talking about, and the institutions absolutely take this into consideration.
And that's average. So when you see a big spike on a day or a week after, say, Netflix reports earnings and it takes off, think about how big that spike is. That is hundreds of millions of dollars, could even be upwards of billions of dollars traded in that particular time frame. That's
Sometimes
massive buying.
And that's what causes those gap ups, Matt.
That's right.
When you get a buyable gap up, this is what we're talking about. The demand is just so huge that stock just takes off.
That's right. And again, these fund managers, when they've made the decision after doing their research that they want to establish a position in a stock, and they're going to say, I want to have X number of dollars or a certain percentage of the fund in this particular stock, they don't just buy it in one day. They're going to tell their traders, I want this many shares or this much of the fund in there around this price. And they're typically going to give a range. And sometimes those percentages can mean huge amounts of money. So those traders may go in and buy a couple 100,000 shares here, or maybe 50,000 or maybe more. Again, it depends on how liquid that particular stock is. But they're going to do that over time. And it may take several weeks. It may take several months for that one fund to establish the position it wants. And in the meantime, there are probably many other funds doing the same thing. And that's why it's so important to track the volume and price action in the chart, because then, although you won't know specifically which funds at that time are getting in, you're going to know that there's institutional activity in that stock.
And of course, that's what builds the right side of the base.
Yep.
The institutions have poured through the numbers. They see that they want to take a position in the stock, and it begins climbing on that right side. And that's why we always look for the buying week by week by week, as it goes up and then it breaks out. And what else happens, Matt? The institutions will go into a stock because on earnings, there's a huge beat, there's big demand for the product, so now they're all stomping on it. And after a strong breakout, that's why you will see it doesn't stop right there. It has a good breakout and it continues to go up because, as Matt said, they are still filling their positions for days afterwards. Once they see an out-of-the-park, crazy earnings report, the institutions can't get enough of that stock.
And that's why sometimes also you'll see a stock breakout, hopefully it's decent volume, but then it just kind of lags around in the buy zone for a while and then really takes off again on big volume. Again, that can be due to funds picking up shares incrementally and then just jumping in at a certain price, or maybe it's a bunch of funds getting in at the same time. And that's what makes that big volume kick in, even if it may be a few days later than the original breakout. So the point of this, again, is to go through your checklist and you're looking for fundamentals, the story, the average daily volume in terms of shares, but don't forget about the dollar volume. You want to have at least part of your portfolio into stocks that do have that type of institutional liquidity. Like any other stock, they still may be volatile, but those are the kinds of stocks that have the best chance to make long, sustainable upward moves.
Imagine a Sunday morning, coffee in hand, you turn on your laptop or tablet and you see a handful of stocks near a potential buying range. That's what you get with Leaderboard from IBD, a timely watch list put together by our market experts, and it's updated throughout the week with alerts to any buy or sell signals. The results? In 2013, Leaderboard has more than tripled the performance of the S&P 500. So to see what's on the list right now, get a free trial of Leaderboard at investors.com/radio show. That's investors.com/radio show.
Now, the final segment of How to Make Money in Stocks with Investors Business Daily market commentator Amy Smith and Matthew Galgani, editor of the IBD Extra newsletter.
So be sure to check out the new buys by top performing funds in the paper. It comes out earlier in the month to see what the best performing funds are buying and what they are selling. And you're going to see the importance of that average daily dollar volume.
And this list will also show you how much money was put into each of the stocks that make the list during that prior 3-month period. So it is a great resource, and you can get that at investors.com/investing show, as well as see the show notes for this week's episode. And also to remind you that we have a new series called Master This Sell Rule, and that's a great way to get up to speed on some sell rules that can help you lock in profits at the right time and cut short any losses.
And if you have not yet checked out the new IBD University, you can do that on the front page of investors.com. Okay, see you next week, everybody.
You've been listening to How to Make Money in Stocks with Investors Business Daily, featuring Amy Smith and Matt Galgani. For more stock ideas and investing strategies, and to subscribe to the free podcast of this show, log on to investors.com/radio show. That's investors.com/radio show.